Good morning, good afternoon, and good evening to all you members of the Smoking Barrel Nation. I'm Rustin Edwards in the Alpine Refuge of Geneva and with my illustrious co-host, Mr. Matt Stanley, based out of hot and sunny Dubai, or I should say
Yeah,
wet and
yeah.
sunny.
You nearly got that out there in your Alpine refuge. Yeah, hello, good morning. Hello, everyone. Yeah, no, 25 degrees. Crazy season is here. Conference season is, well and truly here. And it's bookends between early November and the end of February. And it's just, the place is so busy. I'm actually speaking in a conference this afternoon down in Emirates Towers, which is not the best position because there's a huge conference going on in the World Trade Center, and it's going to take me about 3 hours to get there. So I'll probably be joining the conference from my phone in the back of a taxi.
Nice.
Anyway, how are we all? I hope everyone's well.
Yeah, well, we've got crude oil markets hitting at the top end of the trading range we seem to be in since November.
Yeah.
Uh, 83.56 is where we closed last night. 83.47 here this morning, down a shy 10 cents. So that's all well and good. I think the market is in this benign geopolitical supporting the market. Macroeconomic data is still providing the resistance to the upside moves. And there's very little to keep pushing it higher. I mean, I think we actually really need to see some type of physical disruption to break through this top end of the range.
Totally agree. And that was your best Bloomberg anchor impression there. That was amazing. You reeled all that off like Marcus Cranny. Marnus Cranny. Sorry, Marnus. No, spot on. I mean, I wrote commentary this morning. Since the start of the year, Brent has hit a low. It was been between $74.79 and $84.80, a $10 range. We're at the top end of that range now, 83.49. Like you said, WTI was off yesterday for President's Day. Happy President's Day, Rustin. So
Woo.
there was no.
They may,
I
they mean,
want to pro
they may have to change that from Happy President's Day to Happy Geriatrics Day with the
Well, you said it, not me, but yes, I agree with you. I want there to be a Prime Minister's Day in the UK and everyone dressed up like Boris and get drunk, drinking brown beer. That'd be a great day for everyone. Um, no, it's WTI was off yesterday. We're off this morning. Look, there's quite a lot to unpick here, isn't there? But I mean, essentially, like you say, it's a fairly negligible range that we've been in. Chinese, obviously, Lunar New Year last week, a thin week. Everyone came back, and I think everyone was expecting a bit more of a pop at the open on the open yesterday.
Well, especially since the data out of China showed that traveling for Chinese New Year was exceeding that from 2019 levels, which is the pre-COVID years.
Yeah,
You'd expect to see a massive uptick in oil prices, or at least speculative oil prices, because of the potential of increased demand
yeah.
forward. But that could be just a blip on the radar. It could be just that people don't buy it just yet because you need other supporting data out of China. I mean, today China cut funding on their 5-year loan rates, first time since June of last year, in a way to try to stimulate the growth of popular. So they cut 25 basis points on their 5-year loan rate to 395 to get more people to try to buy property. So the Chinese government is trying to do something to stimulate, but I think that's more of a yawn because it doesn't really do much.
Well, look, it's a good point, and I think we mentioned it last year many times, weekly probably when we were series 3 of the Smoking Barrel, your favorite energy podcast. It was all about China complacency. People have got up around China demand. It's got to pick up the slack. I mean, look, I think you're right, and you hit the nail on the head. There is that um, the property sector is just a laggard of the whole economy within the country. People can't ignore it. China was the worst performing stock market in Asia last year. And when you kind of put that into context, you realize how grim it is. They should be leading the way. They should be second biggest economy in the world. And to have the poorest stock market last year and the whole of 2023 speaks volumes for just how people are pricing in what Chinese equities are worth and outlook. But I think you're right. I think this year's a new year and year of the dragon, and a new year, new hope. I thought a lot more optimism would be priced in with the data that you mentioned. Travel back to pre-pandemic levels. I hope we move away from pre-pandemic soon. It's just a 5-year high because it is essentially a 5-year high. But no, not at all. And it's it you know
Well,
India's Nifty 50, that's been fairly muted so far this year as well. I just think all of it boils down to a higher for longer interest rate policy that the world seems to be going through based on continued data coming in hotter than people were anticipating. I mean, bringing it back into what it means for the Middle East, we saw a local bank here, which will remain nameless, increase their interest rates yesterday. Now, they probably decreased them overly optimistically in the first place, thinking that the Fed would have started to reduce the interest rate hike cycle they've been on, or at least the rate hikes have stopped, but monetary policy becoming a bit looser, but not to be. And I think that you called it a few weeks ago when I was in freezing Prague that there probably won't be a rate drop for this year. I don't think that, but I certainly don't see one until the end of Q3.
I'm still a believer that the Fed will hold their powder dry, just because the economic data of the United States continues to be robust and strong. Consumer confidence in the United States ticked up, according to the Michigan Consumer Confidence Survey. So that tells you that the consumer might still be there to support the economy, even at the high interest rates. I mean, job growth is still fairly good in the United States. Unemployment is low. And so you don't really have a lot of the ticks that are keeping the Fed up at night. And with inflation still above the 2% target that the Fed tries to go for, they may just hold everything, just let things kind of simmer and mellow down, and hopefully you see a slight decrease in CPI levels. But again, I don't see the Fed making any drastic moves until 2025 because there's no need to. Uh,
Mm.
I think the real interesting factor, I think, going into Q2 and Q3 is going to be how does the European economy and the UK economy put a drag on the US economy, if there is a contagion effect or not. Because I think most people would look at the data out of Europe and say, yeah, Europe's in a recession. It might be a very shallow recession, but they're still in a recession. UK looks like it's in a recession, and you have Japan in a recession. So you've got a fair amount of major economies that are impacted by poor economic growth, which is in turn impacting energy demand, which is in turn impacting manufacturing and industrial production in all these regions.
No, I mean, I get how important US monetary policy is for global sentiment. I think we all do. Um, but are we really saying that the whole reason that there hasn't been a spike in energy prices, there hasn't been, you know, how it's been affected in Asia, i.e., what happened with Chinese equities? Equity markets in the US are doing well, better than ever, record highs. Crypto's doing very well. Not like I give a shit about that, but that's doing very well. But are we saying that forget everything else? All that matters is interest rate policy in the US. Is that all the market's relying on right now?
Well, I think that's a big driver of the market because interest rates drive trade. If you have high cost of cash, high cost of capital, if you're a smaller, medium-sized company, it may impact your ability to do business because your cost of finance has gone to a point where you don't have enough margin in the trade to actually do something. I mean, if you think about, you buy 1 million barrels of oil and the cost of financing is at, in some places 11, 12%, because it's LIBOR plus and LIBOR is at 5. So you're at LIBOR plus 3, LIBOR plus 4, LIBOR plus 6, depending on how big of a company you are. All of a sudden that becomes a very material impact and you can't do the business. And so
Yeah,
it
I
does
know, but you you've
restrict
you've
trade and
always
restrict prices.
yeah, I know, but you've always said that, and I agree with it, is that we aren't in a high interest rate environment. If you go
Well,
back 20 years.
we're in an average interest rate environment from a historic basis, 5%. However, there was a lot of business that was developed post financial crash that was living off 0 to 1% interest rates. And when you go from 0 to 5%, that is a significant cut to your bottom line because your cost of money has gotten higher. And therefore, it makes it where your ability to do business becomes less and less feasible.
Yeah.
Um,
Yeah. Look, I mean, if we just, you know, I'm not an economist at all. But if we just bring it back to what I think we can talk about a little bit about, which is oil, energy, whatever you like, shipping. Um, in terms of things being stable, things have been stable. We started today talking about a $10 range on Brent. We've started the year with gas stocks in Europe being higher than ever with a mild winter, so there's no concern now. Last week we spoke about the end of winter buying season. We're certainly past that now. Um, Oil production has increased, if anything, and there has been no disruption with supply apart from a longer sailing time because of the Cape of Good Hope and the Bab el Mandeb issue. So we're kind of, I would say right now, I would argue that we're probably in the most benign conditions Brent can find itself in, regardless of the issues that are happening in maritime security in the Red Sea.
I would tend to agree. I mean, I think if you're the proponent of peak oil demand, such as myself, where we are in the middle of peak oil demand, yeah, we're in a very benign situation. When you look at the IEA's forward forecast, they have stock builds for the rest of the year on crude, barring no change to the supply situation. OPEC Plus still remains to be pumping oil, and they failed to meet their cuts that they announced in January.
Yeah.
So the fact of the matter is, I don't think OPEC wants to, or at least OPEC members don't want to cut themselves off from the money they can make today at $83 crude, and so they're going to produce as much as they can because the cuts are voluntary; they're not mandated by the alliance, and they have never really hit their number of what they needed to make. So therefore, the market keeps well supplied, and stock builds are going to happen. I mean, when you look at it from a global perspective, China is not buying huge swaths of crude at these levels. You've got the US doing their SPR fill, but that's 3 million a month because that's all they can really do to fill up the SPR, and that's just going to take time, assuming that they award the tender to buy the crude. I mean, really, I think from a geopolitical standpoint, the only real question you have on supply is the Ukrainians continue to impact Russian oil infrastructure inside of Russia, and B, will Venezuela impact Guaiana? Because I think everywhere else it's kind of benign and kind of steady state. There's no change.
Yeah, I mean, okay. Yeah, you're right. I think, okay, there's a couple of things I want to pick out there. So fairly benign conditions, but it seems like, which seem to be all centered around, if we boil it back down to current fiscal policy in the US. So definitely one to watch whenever there's minutes of the meeting out, reading between the lines, seeing what's going to happen. In terms of things, just moving on slightly onto freight. You mentioned there about China and not buying lots of oil. We saw Middle East VLCC rates surge last week. So VLCC being the very large crude carrier, Middle East Gulf to China was at a 6-month high. We've got that up 60% since the start of the month. I mean, is that demand being pulled, China pulling oil from the Middle East because, things like the Lunar New Year celebration story, they are drawing down on stocks. Refineries are, at good utilization rates. Or is there just a general surge in freight costs because of what's happening in Bab el Mandeb or Red Sea?
Um, Basically, Bab el Mandeb has increased ton miles across the board, and so with that, there has been a support in the cost of freight, especially on your large freight and on your Suezmax freight. So it's a general impact that's been going on, and so you do have longer lead time supply, and you have other markets that are pulling on VLCCs to load out crude. So when you have those confluence of issues, yeah, it makes Mideast prices go up, U.S. Gulf Coast prices go up, and voila. I mean, when you think that you don't have any crude really transiting through Bab el Mandeb, and
Yeah,
the recent fixtures are all going around the Cape to move crude into the Mediterranean refining basin. I mean, that's a huge change in ton miles that wasn't there before. And when
yeah,
you have that change in ton miles, it just causes prices to go up because there's only so many VLCCs in the world. They're not infinite. There's only 800 units.
Yeah, I mean that when you think about that, I mean, look, I just want to boil some of those numbers down because our freight analyst Matt Wright, he wrote a piece yesterday and exactly the same. I mean, the Middle East accounts for around 65% of all VLCC exports, but higher exports from the US to Asia has been the main driver of VLCC ton miles in recent years, following OPEC cuts. I mean, you're at the coalface there. You're seeing it. The company's benefiting. It's the outlook is positive.
Yeah. I mean, if you look at pretty much anybody who's in the tanker space, especially the large tanker space, they're all very bullish on forward rates because you have a fixed pool of ships that are aging every day. They get older, and after 20 years, they become commercially non-viable. And you've got a limited order book on the forward end of the curve. So you've got this dichotomy where your tankers are getting older and you don't have any replacement freight coming in. So you do have an imbalance of how much freight is going to be commercially available in 2 to 3 years and how much is available today with the longer ton mile. I mean, when you think of it from a ton mile perspective, a ton mile is how many miles or how many tons you move in a mile on a ship. And when you think of it, that a VLCC carries 2 million barrels of crude oil. Now, if you take Saudi Arabia production, how much are they producing every day? And how much are they exporting every day? If they're exporting anywhere between 4 to 6 million barrels a day, that's 2 to 3 VLCCs that have to load every day to contain the Saudi export volume.
Right.
And then that ship, once it loads, is on a 90-day voyage. That's from load port to disport in China, back to load port again. So you need 90 times 3 ships, which is 270 vessels, to contain just Saudi exports. If it's
Yeah, I mean, yeah, okay. I want to just interject there because my colleague Rustin in Singapore, you know, it's all very well talking about, stuff that you and I talk about every day, VLCCs, ton miles, increased costs or what freight's going and what's happening with energy security. But if you are in specific areas within the world geographically, you do face a crunch. You do face energy security issues, and no more so than the Red Sea itself, the countries in this. So that's Djibouti, Sudan, Eritrea, Egypt, Jordan, Saudi Arabia's west coast. Last week, we saw the world's largest protection and indemnity clubs, P&I clubs, they're called, from Skald and Guard to the American and the London Club. These guys insure about 90% of the world's ocean-going fleet, right? And they all pulled coverage going through Bab el-Mandeb. And that's a huge number. I mean, there are still ships going through. I know we'll touch on that in a minute. And obviously you've got the pipeline that the Saudis have from the east of the country to the west, the Petroline pipeline. But if you are in the Red Sea, it's going to cost you a lot more to import oil because simply vessels are not going to be positioned there. There is infrastructure, but it's, you are a target market. There is no flow through trade because there's no flow through traffic. I mean, this is the kind. I mean, I don't. Sorry, I'm kind of making these statements. I'm not trying to tell a story there because I don't know where it goes. I don't know where that story ends up, where it lands. But it is a big risk. And I mean, how many people around the Red Sea? I'll have to look at it on someone, a visual capitalist or something. How many people live around the Red Sea and the Suez Canal, and what kind of, how much revenue is generated from Suez Canal fees. We know it. I think it accounts for something like 15% of Egypt's GDP. It's a huge amount, especially on foreign reserves.
Revenues are down 40 to 50%.
Well, I mean, it's frightful. I mean, what do you? I mean, if you were to say Yanbu, Jeddah, Rabigh, Shuaibah, Shukaik, those West Saudi ports, I mean, it would be something you would be concerned about, no?
I would say if you're Saudi, your biggest concern is the Hajj. Because Saudi receives a massive influx of pilgrims during the Hajj. It's almost, I believe numbers I've read, and I hate to quote this, but roughly 2 million to 3 million people a day come into Saudi Arabia for the Hajj. And that is usually a large infrastructure import. I mean, not only are they bringing in fuel to fund all the electricity demands from all the pilgrims that come in, but there's also food that's brought in, and other materials brought in to help support the people on the Hajj, because it is water, food. There's a fair amount of activity that goes on, so people are on their feet, moving along, and they all need support. And
Yeah.
so, if you're Saudi, that's got to be your number one concern at this moment, at least in my mind, because if you can't get your energy into the region and you can't get logistics support into the region because of what's going on in Bab el-Mandeb, it could make the Hajj a very difficult event this year.
Yeah. I mean, I'm just looking, I just want to, everyone goes on at me for talking a lot, and I'm very guilty of it, I know. But there was a boat called the Free Spirit, which was a cargo of fuel oil that loaded out of Fujairah that was heading into Yanbu for the power plant there. And she turned around twice. You see her pass. She was south of Oman. She turned around. She's going to go back up to Fujairah because of the issue. Then a week later, she carried on going towards Yanbu. And then on the 12th of Jan, turned around again before eventually going through the straits. And she discharged in the end around the end of January. But even a behemoth like Saudi, being big fuel oil importers as they are for their power generation, like you said, especially coming up to certain events like we've got Ramadan coming up, which is in about a month's time, and then you've got the Eid celebrations, and then Umrah. Except the Red Sea was with Jeddah and Mecca and Medina.
It's a hotbed of activity because you have the
It
power
is,
crops,
and
you have
yeah,
all
and
the agricultural ships that come in, you have the container ships, and you have the oil that comes in. I mean, so it is, if you're a Saudi, you have to be concerned that, Hajj starts on June 14th this year, which is in the beginning of the summer. So that means you need to have that infrastructure in place and things ready to go to make sure the pilgrims, when
yeah.
they arrive, they can do what they need to do with least impact. So
Yeah, and this is I know I hate sort of starting a story and then being no sort of conclusion. But the irony is that no one knows what it is yet. It's not like I'm not telling it because I don't know. It's nobody knows. Like you're talking about ambiguity and hesitation from, you know, the world's biggest oil importer, producer, Saudi Arabia, um, not knowing really what's happening when it comes to security because of the issues in Bab el Mandeb. That's unprecedented and something that's untested. And I mentioned in my commentary this morning that sadly, what's happening in Russia, Ukraine, and what's happening in Bab el Mandeb, the news value has been taken out of the story. People don't read the headlines. If it's happening every day, then it's kind of the same old news that's being recycled. But it is still happening. People are still dying, and people are still. I don't know. It's just I can't look anywhere else right now apart from what's happening in the Red Sea when it comes to oil markets and how to opine on them.
well, and that's why we're where we're at with price, because it's geopolitical, and it's, does it escalate into something more, or is it just going to be a regional little blip, and it doesn't really impact the greater flows of oil around the world? And
Yeah,
I think, from a logistics supply standpoint, for the most part, everything's been rerouted. For the most part, there's still people transiting through, as you pointed out. Ships are still being hit by missiles, or by mines, or by whatever other means the Houthis have to hit a ship. But for the most part, the markets have rebalanced and are now mainly in an avoidance stance versus trying to run the risk and run the gauntlet.
yeah.
So, um, is there going to be a blip in inflation because of this? Probably. And that's probably why I don't see central banks cutting rates, because higher freight costs, it takes anywhere between, 4 to 6 months for that to roll into the cost of goods, which then gets passed on to the consumer, which then causes inflation to go up.
Yeah.
Uh, and so we should start seeing, at least in Europe and the United States, that impact of inflation from this start impacting goods now, into the summer. And so therefore, we've got to see how that actually rolls through, and that's going to drive the interest rate decisions in my mind, and that's going to keep things steady and stable going forward.
Yeah, yeah, and I I hope soon we'll record a podcast where things are a bit brighter. We can report on happy things and babies or whatever. Nice. People coming into the world and it's all a happy place. But unfortunately, it's all a bit shit. And we have to still record it with a happy face. Anyway, look, I've got to run to a conference because I'm very important and senior. Um, and next week we won't be recording. Why is that, Rustin?
It's called International Energy Week in London.
No,
Hopefully,
it's not. No,
see
it's not called that.
market.
It's not called that. It's called
Peak demand,
International Petroleum Week.
peak demand, energy transition, first and foremost on everybody's lips. Got to think about those new alternative fuels, new energy sources outside of fossil fuels. Oh,
I've decided I'm gonna go to one of those crappy merchandise stalls in Trafalgar Square and buy an "I'm with Greta" T-shirt so I don't get attacked.
but yes, look forward to seeing you all in Shepherd's Market. I'm sure you'll find myself and Matt Stanley rolling around somewhere there. Happy to converse about oil markets, supply, demand, and anything else you might want to talk about. Rugby, Arsenal.
Sure, yeah, maybe you like.
Well, thank you all very much. Click like, comment, subscribe as you see wish, and we will catch you all in March.
Ciao.